Hi, this is Tony Turner back with you again. Thanks for all your great comments about my last video. I love to see your comments and questions. When you participate like that, it shows you are really serious about learning and progressing. And in the world of trading, that's really the name of the game. You can never sit still. You always need to keep improving through education and training. And now let's get back to where we left off the last time. If you remember, we were talking about how some short-term trading strategies work pretty well, but they end up leaving a lot of money on the table, especially if the traders get out of a trade too soon. Now here's an example on a daily chart of the CBRE group. The stock bottomed out, as you can see, last July, in July last year, and then began to trend higher in August. It actually stopped and shot above its 200-day moving average on strong volume, and we can see the volume right here. By the way, the ability to recognize volume signals and what they are telling you is an integral part of trend following strategies. Now back to our chart. CBRE penetrated the 200-day moving average, this black line right here, moved higher once again in September, then broke out of that consolidation and rocketed to a new high, over a 20% gain. Alas, however, that high did not hold, and CBRE returned back down to its 200-day moving average, and it even fell below it for a couple of weeks. The entire drawdown from the highs up here down to these lows was actually about 19%. And it's easy to understand why many traders would have, at some point during this slide south, tossed up their hands, exited the trade, and then, in typical trader fashion, said, "I never want to see CBRE again." Those who were trend followers, however, and knew what to watch for, saw CBRE reverse to the upside and walk up a subsequent trend that delivered another 27% gain. Wow. Now in our last video, we were also talking about how so many traders are using strategies that seem to be working, but their profits are actually much smaller than they should be. As a result, they are forced to make a lot more trades just to try and generate a decent income. But there's a dark side to making more trades like that. Your profits get eaten by the increased commissions that result from all that additional account activity. When you get caught up in this cycle, you can't help but feel there's no solution to the problem. That's one reason, it's a big reason why so many traders get burned out quickly. They're working harder and harder for very little additional income. Now all of that hard work can really take its toll on you, so you need to be careful. How can you honestly expect to make intelligent, confident trading decisions if your brain is exhausted from working so much to find additional trades? Fortunately, there is a better and easier path for us to follow. The idea is very simple. Instead of taking just a portion of a trend in a hit and run profit, I'll show you how you can double or triple your typical profits in a trade by simply getting into the trade a little earlier and staying in a little longer. Our goal is to identify the beginning of a trend before anyone else and then spot when that trend is finishing up so we can exit safely and bank our profits. In other words, it's about working smarter, not harder. Like I told you in the last video, there are plenty of so-called TV experts and others who will tell you that there's no way the average trader can determine exactly when and where these important start and end points will occur. But I'm here to tell you that their views on this aren't just wrong, they're also dangerous. First of all, because you can look at a chart and see that these reversal points do occur, right? We can see them with our own eyes. So the only thing we need to figure out is how to identify the reversals as early as possible and target those that have a high degree of probability so that they will continue that reversal. So when we're told it's impossible to do that, what they're really saying is maybe they don't know how to figure it out for themselves. Even worse, they're implanting the idea in your mind that you can't do something. And when you give up on something before you even try it, to me, that's one of the most dangerous things you can do to yourself because it limits what you're able to achieve. Please don't do that. Please do not limit what you think you can achieve. When you look at the history of progress in the world, it's really the story of countless people who have pushed beyond boundaries to achieve great things. It's the same in our individual lives too. When we open ourselves to the concept of achieving anything, it's amazing what can actually happen. And here's the really great thing. When it comes to extending our profits in any given trade by capturing a wider part of the trend, we don't have to get in at exact earliest point, and we don't have to exit at the exact top to improve our results. As I showed you before, most trading strategies are only capturing that little percentage of the trend. A lot of them, as you see on this graph right here, and when we swing trade, which is a valuable method of trading, but certainly if it's all we do, we can limit ourselves. And if we're lucky enough to catch the center of each move up, that's a good thing. But why not capture the whole center of the entire trade? If we get in just a little earlier and get out just a little later, we're already increasing our profits on that same trade. Now imagine how much that can be worth to your bottom line when you apply it over all your trades in a given month or year. It can easily double or even triple your regular results without adding any additional commission expenses. Now let's dive in so I can show you how I do this and how you can too. But first, I'm going to tell you a quick story here, and one I'll never forget. In 1999, I was in a trading room in New York. I started watching a little biotech stock based in San Diego out here in California called Nanogen. You can see it right here on a monthly chart, and we can't look at a daily or weekly chart because it goes back so far there aren't any available. But as you can see on this monthly chart, Nanogen started down here at about $4 early in 1999. Started back down here. It actually moved up to about $7 in the mid part of the year and then just kind of moved sideways, as you can see, for the rest of the year. Now at that point, right in here, I bought a few hundred shares in an IRA account that I had with a large traditional broker. Their commissions were hefty, and I certainly wasn't going to trade that account. So I left that position alone. I just bought it and left it there. However, I did begin to trade Nanogen in my regular trading account. Now, by December of that year, Nanogen rose, as you can see by this candle, to over $24. And then, as you can see by the chart, Nanogen actually rose by the March of 2000. Of course, that's when the tech boom was going on and everything was going higher. If you remember that, it actually rose to $101.75. I had the good sense to exit at $100. And I'll never forget calling my broker. Oh, I meant to tell you, as you know, many times the $100 level can be a reversal point for stock prices. In this case, it certainly was. I called my broker at the big firm and I told him to sell my shares in my IRA account. Needless to say, since I bought in at 7 and closed the trade at 100, he was very, very impressed. But that was my hands-off trade. I just bought it down here and sold it when it got up to this point. Now, by the end of March, and this was the part, again, of the 2000 burst of the tech bubble, poor Nanogen fell back to $25, then gradually, in current, rose up a little bit here in 2000 with the rest of the market. And now, please don't trade it. It's trading back down as a penny stock or under. But those numbers don't matter. Here's what really matters. In my trading account, my regular day trading account, I day traded and swing traded Nanogen for most of its move up, for this move up in my day trading account, in and out, in and out, in and out, in and out. I did well enough, but I had to sit in front of my screens for hour after hour, day after day, and rack up commission after commission. And of course, all of the trades were not winners. I mean, Nanogen traded up and down like everybody else. All the trades were not winners. The position I bought in my IRA, however, gathered the entire profits from my entry at 7 to my exit at $100. Now, which position, which account do you think made the most money? My IRA was a 10-bagger plus. My day and swing trading profits didn't come anywhere close to those gains. Now, to me, trend-following strategies take the best of investing and the trading worlds and unite them in a single profit-rich system. Will you ever have a losing trend-following trade? Of course you will. But I can give you the rules and tools you will need to minimize losses and maximize gains. Here's a more recent trend trade that I made. The UGA, which is the United States Gasoline Fund, ETF, bottomed out with most assets back in November of 2012. I didn't enter there because this price pattern you see right here is too disorganized for me. I like orderly price patterns. Once it moved back, though, to its 200-day moving average, then made a higher low from the last low, from the November low, and then rebounded, bounced up back off its 200-day moving average. I bought shares at about $55.80, where you see the green arrow. I then held for the duration of the uptrend, all the way up, and sold half my position up here on this candle. Yes, I did. At about 65 and change. I sold the remainder of the position when the trend weakened. Now, why did I sell up here? Look what volume is telling us. Major breakout volume occurred in January. See this volume here? Right all in here. This was the major breakout volume that propelled UGA higher. There was some back here. I didn't use that. Very little in December because trading is low in December because of the holidays. But here came the volume up here. And especially, of course, because UGA, moved up over that higher trend line there. But the volume came in here. That was the breakout. Then usually, if a trend moves higher, volume will back off a little, as it did with UGA. But when you see a stock or an ETF, whatever you're trading, move up to an overextended, overbought area and get huge shots of volume, that usually means sellers are coming in. It isn't all buying. It just appears to be, but it isn't. When I saw that huge shot of volume that could be distribution, that's when and the stock was overextended, making new highs, overbought. I chose to sell half of my position there. It told me sellers were present. I knew I was pushing my luck, and I had a little over 18% profit in a little more than 2 months. So I took some profits, and then when I waited to see with the remainder of my position if the UGA could move higher yet, because one never knows. However, it didn't. It weakened. It rolled over, and I sold the rest of my position for a nice profit. Now, please know the major point here is I made this trade with very little effort and very, very few commission costs. I was armed with a set of common sense rules and a foundation of knowledge that serves me well. Now, obviously, this is just a quick overview of how you can extend your profits using these simple strategies. Now I want to show you how I make these trades and give you even more valuable skills and strategies at a special 2-day webinar that I've been invited to teach. Please sign up right here on this page to get into the VIP list for a special discount on the program. Spaces are limited for this exciting 2-day information-packed webinar, so please sign up now so you don't forget. When you join me for this webinar, I promise to give you a lot more tools you can use right away to begin extending your own profits in virtually every trade. It's going to be a lot of fun and very important to your long-term success in the market. So hurry and sign up for the VIP list now. I hope to see you again soon.